It's not an open meeting.
Really? Nope. Wow, that is, good morning. I'm Catherine Summers. I'm the director of the Senate Fiscal Agency. I am this year's calendar year's chair for the Consensus Revenue Estimating Conference. To my far left is Chris Harkins, director of the State Budget Office. Immediate left is Rachel Eubanks, director of the Treasury and State Treasurer. And to my right is the director of the House Fiscal Agency, Mary Ann Cleary. Statute, specifically, MCL 18.1367B in the Management and Budget Act, so this is section 367B, requires a revenue estimating conference be held the second week of January. And thankfully, it wasn't really snowy for people who are coming in today, one of the rare times that's the case. And also in the third week of May each year. The conference is required to establish an official economic forecast of major variables of the national and state economies and establish a forecast of anticipated state revenues. Those are my opening remarks. I will see if anyone else has any opening remarks this morning.
Beautifully stated, nothing to add. Nope.
All right, well, we will see if we can get a jump on our agenda then. We will start this morning with the U.S. and Michigan Economic Outlook and State Revenue Estimates with Daniil I'm going to mess this up, Menenkov, close, and Gabe Ehrlich from U of M. So this is RSQ, Research Seminar in Quantitative Economics. Daniil, a little bit of background on Daniil, economic forecaster at U of M, lead research area specialist at RSQE. Main areas of expertise are macroeconomics, monetary economics, and applied econometrics. Daniil received his PhD in economics from the University of Minnesota and holds a Master's of Science degree in applied mathematics and physics from the Moscow Institute of Physics and Technology. Daniil has been involved in forecasting the U.S. economy for more than 15 years. Gabe is an economic forecaster also at the University of Michigan and is the director of RSQE. Published articles in New England Journal of Medicine, Review of Economics and Statistics, Journal of Urban Economics, and Journal of the European Economic Association. You oversee the RSQE forecast of the U.S. and Michigan economies. Regular presenter, both of you here, and we would like to welcome you up for presentation. Thank you. Good morning.
Good morning. Thank you for the introduction. It was certainly the most recent one, and your spelling is pretty good. All right, so thanks for inviting us back, and thanks to all the members of legislature attending in person or virtually. I'll be talking about our U.S. outlook, and Gabe will talk about our Michigan outlook, and we'll take questions jointly after both of us are done. So let me jump back in, right back into my presentation and start with where we are in the economy right now. Let's see if I can get this to, guess I'll have to do this. All right, so first let me talk about the main indicator of them all, that is the real gross domestic product. And this is a little bit of a busy chart, so let me walk you through what's charted here. So first I have the real quarterly GDP growth at an annualized rate in the solid black line. And the latest reading here is 3.2% pace in the third quarter of 2023. I also have in colored stacked bars contributions of major components of GDP to that 3.2% growth and to the past numbers. And I want to stress one thing. So on paper, 3.2% growth was pretty strong. However, if you look at the gray bar, which is the contribution of net exports, it added about 2.9% to growth, accounting for a lot of it. So with things happening in the world, with recessions in Europe and some of our major export markets, we don't expect the gray line to continue. And if you look at the past history, it moves around quite a lot. Typically, net exports, but also the green line, which is the contribution of inventory investment, moves around a lot and accounts for a lot of the variance of these quarterly numbers quarter to quarter. So one way to look at the trend of what's happening in the economy is to strip them out and look at the sum of consumption, government spending, and investment. So I'm going to do that on the next slightly modified chart. So the dashed blue line here is the sum of those three components, and it's called final domestic sales. And what I'm plotting is the contribution of those three components, so consumption, investment, and government spending to that 3.2% number that I cited. And here the picture is a little bit less rosy. Still, there's an improvement on the second quarter, which was about close to zero, and the latest reading is about 1.6 percentage points. So there is growth. It's modest. It's not at the 3% pace, but it's solid growth. It's continuing. The big contribution to this growth is what's happening to consumption expenditures, and those have been growing in general, but there's a dichotomy. The consumption of goods is coming down because we were spending way too much on it over the pandemic, and now it's trending down. The consumption of services, on the other hand, is getting back to trend still, and it's a little bit maybe below trend, and there may be some room to grow there. One more thing I want to stress, and I'm going to have a chart on this a little bit later, is that non-residential investment in chip manufacturing is taking off like crazy. And that's been helping definitely in the last quarter, and it's going to be helping probably for the next few quarters. Now let's talk about inflation, which is the big story of last couple of years. So here I'm charting two things. I have 12-month inflation rates for headline CPI in yellow and core CPI, that is subtracting food and energy, and that one is in blue. So the latest readings are 6.4% for the headline and 5.7% for core. They just came out the other day. Now, at face value, those are still pretty high readings, but we had a streak of 3 months where the month-on-month pace, if you annualize it, is much slower than these numbers, which is roughly in line with about maybe 3.5 pace on core. And we care about core because core tends to be a good predictor of what's to come in the next year or so. So we typically focus on core, and the Fed typically likes to look at core and maybe some other measures of core. So the latest pace, around 3% or thereabouts, is still probably above what we should be seeing. So it's good news that the inflation decelerated. It's not a victory lap by any means just yet. We may see some reacceleration, so it's probably too soon to celebrate. Still, it's good progress. One more slide on inflation that I want to stress out, and this gets a little bit convoluted. So here I'm only focusing on core, and if you pull historical data right now, it will look like a yellow line. The problem with that is that it's not using a consistent approach to measure things, and basically around 83, it's been spliced with an older methodology, which measures the effect of housing prices, but also some of the interest rate sensitive prices differently. So if you look, there is a consistent series available going back to 78, and if you look at that series, which is plotted in blue, you can see that the peak was much lower, not 14%, but under 10%. But the point I want to make is that the level of disinflation that we have achieved in the 80s, that is declining from about 10%, under 10%, maybe 9.5%, to about 4% that we've seen in the second half of 80s, was about 6 percentage points. And that took a severe recession to achieve. Right now, we're looking to achieve about 4.5 percentage points, going from like 6.5% to 2%. So it's quite comparable, but we think it's still going to take a mild recession to achieve that, to extinguish inflation for good and to get back to around 2%. All right, so next, let me look at some other, I'm not going to present a complete picture because there are a lot of conflicting things, so I've picked a few things that I think are the most informative. So first, let me talk a little bit about housing. We know it's under stress. There are lots of other indicators out there. I'm just going to show you two. So with mortgage rates breaching 7% briefly in December, backing off a little bit, but still lingering pretty high. So housing is pretty much in the coma right now. So two metrics that I have is, one of them is National Association of Home Builders Housing Market Index, and that one is in blue. And you can see it's basically back to levels that we've seen in 2012. And 2012 was not a good year to be a home builder. The other measure is the Mortgage Banker Association's purchase-only applications index. And that one is, again, back to the like 2010s, early 2010s. It's also like back to what we saw like in early 90s. So it's scraping along the bottom that we have seen over the prior 25 years. So it's stressful out there. One thing I want to stress, and it's going to be important for the labor market picture, residential construction employment is still growing. So all the stress we're seeing has yet to translate into declining employment because there's been a significant big backlog of projects. They're working through it, but they will work through it. So basically, maybe a few months from now, we'll see a contraction on residential construction employment. Here I have the two measures of what's happening in the economy. On the manufacturing and the services side, the data comes from Institute for Supply Management in Chicago. And these are purchasing manager confidence indices, and these are diffusion indices. So any readings above 50 indicate expansion. Readings below 50 indicate contraction. So manufacturing is in yellow, and you can see it's been trending down for a while, and it finally dipped into contraction in November and December. It's less worrying because you see several episodes of contraction over even a prior decade without triggering a recession. So that tends to happen. What is worrying me personally is the sharp drop-off in the service sector diffusion index just this month. This happened like a week ago. And we don't have as long history for this series, but it's not been in contraction outside of a recession. I hope it was a fluke. It was largely driven by new orders. And if that were to persist, it would be severe negative risk for the economy because, as I said, consumption of services was what's been driving GDP in the last couple of quarters. So this is important. Keep an eye on this. Things are not as dire on the housing in the labor market. So here I'm showing you the monthly payroll job gains. I have a split vertical axis to be able to show you minus 20 million without jeopardizing the resolution of the chart. Lately, you can see the downward trend in the pace of monthly job gains, but the average of 240,000 jobs over the last 3 months is pretty healthy by the standards of the prior decade. 223 that we got in December is still pretty good. Looking at some other indicators in the labor market like new unemployment claims, there's nothing to worry about there just yet. Even though you're hearing some news about mass layoffs in the tech sector, if you look at the indices like, indices of mass layoffs, they are basically very, very concentrated in the tech sector. And some early data suggests that people who have been fired from, Facebooks and Twitters, most of them found new jobs pretty quickly. So there's a trend towards softening. It's not dire yet. It's pretty strong so far, so which is why we think the near-term momentum is pretty strong. And if there is a recession, we think there's maybe like 65% chance of a recession, and it's our baseline scenario. It's probably going to happen late in 2023. The chart that I promised you earlier, so this is what's been happening to non-residential investment in structures related to computer, electronic, and electrical manufacturing. And here we have seen, like last 30 years, some modest activity. Lately, there's an explosion. So part of that explosion happened before the CHIPS Act passed last summer. And that was basically a response to huge shortages of chips that we've been experiencing for the past year, maybe year and a half. Since the CHIPS Act passed, there's been about $200 billion announced of new investments into chip manufacturing. A lot of that has already started ramping up. So basically, a lot of places have broken ground on new factories. But we think this line is probably going to go higher and is going to help at least near-term growth until it stays high at a sustained high level. Unfortunately, to the best of my knowledge, Michigan isn't getting much out of that money. I hope to be proven wrong ultimately. Maybe there's a way. Finally, on the current state slide, let me show you what's happening to the light vehicles market. And here I have two things charted. First is the 3 months moving average of the pace of domestic light vehicle assemblies in blue on the right-hand scale, but also have monthly light vehicle sales pace in yellow on the left-hand scale. Those are both in million units per year. So say domestic production, again in blue, is basically ramped up to levels that we have seen shortly before COVID. So it's probably more reminiscent of the period that when there was a strike just before COVID. So there's probably some room to grow, but it's pretty good recovery. The sales level is stuck at a pretty low level. So it jumped for maybe a month early in 2022, and then jumped to 15.2 million pace in October, but then backed off to about 13 million pace in December. And there are things that are probably constraining sales. So inventory level basically cratered sometime early in 2021 and has been pretty low since. And it's probably constraining sales. It's hard to say to what extent exactly, but inventory situation is improving, so that should help. Pricing power by auto manufacturers is surely good for them because, I mean, they have to spend billions and billions into electric manufacturing, so it's going to make the bottom line a little better, but it's definitely costing us some sales right now. So we think there's no clear path to like getting back to 16 or 17 million units in the next couple of years. We project a gradual recovery, and Gabe is going to show our projection, but if you have questions, I'll be happy to answer. So with this, let me jump into assumptions for our forecast, and let me talk about our policy inputs. So as I've discussed, there is progress on inflation, but it's still elevated. And the labor market remains pretty tight. So we think both sides of the, so basically there's no tension for the Federal Reserve. The market is tight and inflation is still high. So we think the Fed is still gonna be raising rates much lower than they have been, but will probably raising rates through maybe this spring. So we expect the Fed funds rate to reach about 5% and flat line there. So consistent with the forecast that I'm yet to show you, the Fed is probably going to start cutting rates sometime early in 2024, looking at some softness or softening in the labor market. Now, on the fiscal side of things, divided government is back. There's probably not much action that's going to happen, and there's probably going to be plenty of dysfunction to make fun of in Washington. Still, we think that the geopolitical situation is such that defense spending is probably going to keep growing, but there's probably going to be a contentious fight about the debt ceiling, and it's probably going to cost us some some discretionary non-defense spending growth in maybe 24. So with this, let me jump into our forecast. And first, like I said, the situation is still pretty uncertain. What we are going to give you is our main outlook, which is for a mild recession. Chances of avoiding recession have picked up lately because inflation has been slowing. If inflation does not reaccelerate or even slows further, the chances of the Fed delivering a soft landing will grow. So with this is our chart for quarterly path in a solid line at annual rate, and the yellow bars are showing the annual averages of growth. So this is what we have. We have resilient growth in near term, gradually slowing from the 3.2% we've seen in the third quarter to just under 2% in the fourth quarter of 24, and about 1.2% in the current quarter. Then we'll see about zero growth and dip into a slight contraction of maybe about 0.5 percentage point in the second half of 2023. And there are several reasons. First, consumption of goods is going to keep slowing. The residential construction is going to be a drag this year, maybe a little bit later in the second half, but it's still a drag. We're probably not going to see much help from net exports because, like I said, some of our key export markets are going to be in recession, and maybe they already are. We just don't have the data just yet. By 2024, the Fed is going to see that the economy is deteriorating slowly, and they'll start cutting rates, and that will help by the second half of 2024. So by that time, we expect growth to ramp up back over 2% pace. Now, the annual figures are a little bit hard to explain mechanically, but they depend quite a lot about what happens to the quarterly growth rate in the final quarters of the prior year. It's just how the trajectory works. So because of that, the calendar year 2024 is going to be weaker than calendar year 2023, just because the contraction is going to come at the end of 23. After that, we expect the growth to recover and pick back up to about 2.3% in 2025. Now, the picture for our labor market outlook, we again have a trajectory from moderate strength currently, getting to a contraction by the second half of 2023. So we gradually decelerate and start seeing job losses in the second half of this year and maybe a little bit to start 2024. Overall, it's pretty mild recession with about 600,000 jobs lost. Again, by the second half of 24, as the Fed is cutting rates, we expect to see a recovery, and jobs gains will ramp back up to about 200,000 jobs per month by 2025. The implications of these figures for the unemployment rate, charted here in yellow, is that it's going to start edging up, and it's going to peak at about 4.5% by early 2024. Then it's going to start declining and go to basically what we think is a long-run sustainable level of unemployment at about 4%. The flat line here in blue is the labor force participation. It typically declines during recessions, but here we have a fairly special situation. We still have plenty of people out there who have not returned to the labor force after the pandemic. Some of them will still gradually return to labor force. So that will undo some of the decline that the softer labor market is going to do. For that reason, we expect that the participation rate is basically going to stay flat. Now, for our outlook for the CPI. So if you look at this chart, which is year over year, we project a fairly brisk deceleration. But what it really is we expect the month-on-month inflation to stay or gradually decelerate for what we've been seeing in the past 3 months, maybe with a little bit of wiggle room here and there. And that will drive the year-over-year sharply over the next several quarters. But really, we're basically hoping that inflation will stay at levels similar that we have seen over the past few months. And there are a few things that are helping us along the way. First, we're seeing that used car prices are basically crashing at a pace similar to the pace they basically jumped up maybe a year and a half ago. Second, shelter inflation is probably going to push us a little bit higher in the very, very near term for a couple, maybe 2-3 months, but then it should start turning over because we have seen inflation of new rents for new tenants basically turned over and it's already declining. So the BLS methodology will probably pick this up, but there's still a discrepancy between what people are paying for new rents versus what people renewing the leases are paying. So there's some discrepancy. There still may be some lingering pressure on the average rents in the economy to still keep going up, but definitely not at the pace we've been seeing lately. During 2024, we expect the deceleration to continue, but not be as abrupt, because some of the things that are going to help us in 2023 are probably not going to do this in 2024. So used car prices look to be crashing, but they're probably not going to be crashing in 2024. Additionally, the service inflation is probably going to stay elevated, which is where there's still plenty of capacity constraints because a lot of businesses closed up. So they'll be looking at rising demand. They'll probably have some pricing power. By 2025, we expect the CPI to settle down to about 2.5% rate. Let me give you our outlook for interest rates. And here I want to stress that rates have been very, very volatile. And this outlook may be a little bit too on the high side because rates have declined in recent maybe couple of weeks. So here I give you 3 things. The dashed green line is our outlook for the 3 months Treasury bill, and it pretty much follows our Fed funds projection. It's peaking at about 5% and declining gradually to about 3% by the end of 2025. The 10-year rate is up sharply this year, and it's going to peak at about 4.4% in this forecast, and that's going to start declining. The big story is what's happening to mortgage rates. As I mentioned, they topped 7% briefly in December. The latest reading is about 6.3%, but in this forecast, we still expect them to edge up a little bit closer to 7 again, and that's obviously stressful for the housing market. The big story here is that typically the mortgage rates trade at about, I say, 1.5 to about maybe 1.8% premium on top of the 10-year rate. Lately, that spread has expanded quite precipitously to about maybe 3%. It happens when things are uncertain, when people, when market participants basically don't know what to expect from interest rates going forward. The more clarity there is about the future monetary policy, so basically the more likely the soft landing, the more likely that the Fed is going to moderate and stop raising rates, the lower the spread is going to be. So we expected the spread to be shrinking pretty quickly over the next year or so. So by 2024, it's basically back to about 1.8%, and that's going to help mortgage rate in significant ways. So we'll be below 6% by the end of 2024. That should help the housing market, which I'm going to show you next. And here I'm showing you the projection for the housing starts, and there are single-family home starts and multifamily home starts, and they're behaving somewhat differently lately. So the single-family home starts have crashed already, and we expect them to decline somewhat during 2023. And they'll bottom at a level of about 750,000 units per year, which is similar to 2015-ish, which is not spectacular, but it's not that dire. Interest rates for mortgages are declining, but not dramatically. So we expect a muted recovery. We're going to see some growth in this, but it's only going to reach about 900,000 by the end of 2025. Now, on the multifamily, there have been a shortage of apartment units. Apartment vacancy rates were really, really low. We've seen that turn over a little bit over the last couple of quarters. So we expect the multifamily construction to ease off over the next year or so. The labor market is also going to put a damper on that. Additionally, some of the vacant offices and maybe retail spaces will probably get converted into condos. So overall, we expect housing starts to decline maybe through early 2024 and then to turn around. So this is my last substantive slide. I have a list of risks. Their policy, war in Ukraine, some fiscal financial stress, and maybe curveball from the pandemic. If you have specific questions, I'll gladly answer those, and now I'm going to turn it over to Gabe.
Well, thanks very much. Ooh, here, do you mind if I do a little rearrangement here? Hopefully I'm not messing anything up. How many economists does it take to manage a slideshow? But anyways, thanks, Daniil, and thanks very much to our hosts for inviting us to present today. It's always an honor to participate in the state's Consensus Revenue Estimating Conference. And just as a reminder, my name is Gabe Ehrlich, and I'm the director of the Research Seminar in Quantitative Economics at the University of Michigan. And I am pleased to share our outlook for Michigan's economy and tax revenues over the next few years with you. Before I show you our forecast, though, I just wanted to take one slide to show you a brief snapshot of where Michigan stands in its recovery from the pandemic and pandemic recession. This slide compares Michigan's employment recovery in the blue line to the national recovery in the yellow line. And so just looking at the yellow line first, the U.S. Job count, the United States economy lost about 14% of its payroll jobs at the start of the pandemic, and it recovered all of those losses by this past August of 2022. And one thing you can see on the chart is that Michigan experienced a much deeper initial downturn at the beginning of the pandemic, losing nearly 24%, so almost a quarter of its payroll jobs at the start of the pandemic. We have had a brisk recovery from that initial downturn, and we've gained back about 93.5% of those losses through November of 2022, which is the most recent state-level data. You can see, hopefully, that the Michigan data ends a month earlier than the U.S. data. But we were climbing out of a very deep hole, a much deeper hole than the nation, and so that still left the state's job count about 1.5% below the pre-pandemic level. So that's where we are right now. Moving now to obviously the light vehicle market, which is very important for the state economy. I'll show you our forecast for national light vehicle sales here in the yellow line, and then the Detroit 3 light vehicle sales in the blue line. And hopefully what you see in the chart is that we're forecasting a slow and choppy recovery in national light vehicle sales. Lingering supply chain shortages, tight inventories, high prices if you've been shopping for a car, you know, and a slowing national economy all inhibit the pace of the recovery in light vehicle sales in our forecast. Sales total just under 15 million units this year in 2023. In our forecast, about 14.9 million units to be precise. They then climb to 15.4 million units next year and 16.3 million in 2025. You know, that would be a pretty good recovery, but you know, you can see on the chart, it still wouldn't get us back to where we were before the pandemic. Sales were running at about a 17 million unit pace, or actually slightly above for most of the years just before the pandemic. So we're not forecasting a complete recovery in unit sales, and it's going to be a similar story for the Detroit 3. Detroit 3 sales fell from 7 million units in 2019 to 5.3 million units in 2022. We're forecasting a recovery to about 5.7 million unit sales in each of 2023 and 2024, and then a recovery to about 6 million unit sales in 2025. And you know, again, that would be very welcome progress, but it wouldn't get us back to where we were before the pandemic when Detroit 3 sales were running at about a 7 million unit pace. And you know, I do want to say a part of the story, and an important part of the story there is prices. You know, we don't expect the Detroit 3 to prioritize sales volume the same way that they might have done before the pandemic. You know, we do expect more focus on high margin, high ticket vehicles, such as light trucks, and an attempt to maintain pricing discipline and margins. And that contributes to the slow recovery in unit sales that we're forecasting. This slide shows you our forecast for payroll employment in Michigan through 2025, along with the history going back to the start of the 2000s. We're forecasting job growth to slow down from 147,000 job gains last year to 73,000 this year, and 41,000 in 2024 amid the national economic slowdown that Daniil showed you we're projecting. Job growth then actually picks back up to about 54,000 jobs in 2025 as the national economy gains strength. We currently project Michigan to recover to its pre-pandemic employment level early next year, so early 2024 is our current tracking estimate. But still, by the end of 2025, our forecast would leave Michigan about 3.5% below its all-time employment peak in the second quarter of 2000. So, you know, it's a good news and sobering news forecast in that sense. I do want to describe the why we're forecasting continued job growth here in Michigan, even as the national economy slips into a mild recession, because as you probably know, that's not the historical pattern. You know, historically, when the national economy catches a cold, Michigan catches a flu, right? And so we are saying this time will be different, and that's usually something economists live to regret. But let me give you our logic, and you can see how persuasive you find it. On this slide, we've divided Michigan's industries into 3 groups, and we've plotted our employment forecast for each group relative to the first quarter of 2020. And just the main reason we do expect Michigan to keep growing over the next few years is because of strength in its blue-collar industries, especially the auto sector. Michigan's blue-collar industries actually made a full employment recovery from the pandemic recession last year, and they're the only one of the 3 groups that has done so far. Auto manufacturers, as Daniil mentioned, are still grappling with large backlogs of demand, and they've really only recently begun to rebuild inventories as the microchip shortage has started to ease. Supply chain issues do remain a challenge. The shortages are not over. They're certainly much improved, but they're not over as of right now. So they remain a challenge in the industry, and that's slowed the recovery in production and sales. With that in mind, we are forecasting that transportation equipment manufacturing will add about 5,300 jobs here in Michigan this year, and then slow down over the next couple of years, but still contribute to job growth with about 3,400 job gains combined in 2024 and 2025. And the outlook for employment in the auto sector is very important here in Michigan because each net job created in the auto sector supports multiple jobs statewide. So even though, the chip shortage has been so frustrating recently, it kind of provides a silver lining today because we're forecasting a national recession, but we expect jobs in the auto industry here in Michigan to keep growing. So that's the good news from the chip shortage, if you can call it that. I do want to point out our forecast assumes that there won't be a prolonged work stoppage in the auto industry this fall in the course of contract negotiations. Obviously, if we did get a prolonged work stoppage, that would change these projections. In total, we expect Michigan's blue-collar industries to grow to about 4% above their pre-pandemic employment level by the end of our forecast. We define higher education services industries as service industries that typically require a bachelor's degree or more education. So essentially, these are the state's white-collar jobs, and they're in the yellow line on the graph. Our outlook for most of the higher education services industries here in Michigan is for continued but slowing job growth. We're projecting employment in Michigan's higher ed service industries to decelerate from 2.9% growth last year to an average of about 1.4% growth per year from 2023 to 2025. So we do see growth, but we expect it to slow down. And with that in mind, white-collar employment in Michigan climbs to about 2.5% above its pre-pandemic level by the end of our forecast. And then finally, we show the state's lower education services industries in the green line, and these are service industries that typically don't require a bachelor's degree or more education. You can see hopefully on the chart, they lost the most jobs by quite a long way at the start of the pandemic, and they do remain furthest from full recovery right now. We expect steady but moderate growth ahead for these industries. And just one point to make is that the retail trade sector is included in the green line here, and we expect that to be a drag on employment here in Michigan, losing a total of almost 12,000 jobs over the next 3 years as the shift to online commerce and shopping continues. And so that's part of the reason for the relatively slow recovery we see in the state's lower education services industries. By the end of 2025, we project Michigan's lower education service industries to recover to about 0.4% below their pre-pandemic employment level. So this slide shows you our forecast for Michigan's unemployment rate. And we estimate that the state's jobless rate averaged about 4.3% in the fourth quarter of 2022. And we expect it to hold at roughly around that level through most of this year before it starts rising late this year, all the way up to 4.7% in the middle of 2024. So that's, I don't know how well you can see, but there's a little bit of a hump shape in our forecast. And that's really happening in the wake of the mild national recession that we're forecasting. As the Federal Reserve eases up on the brakes and economic growth starts to pick back up, you can see Michigan's unemployment rate starts to fall again in our forecast, all the way down to 3.9% by the end of 2025. And that would be just about in line with where we were before the pandemic here in Michigan. And just the fundamental point is, in our view at least, the era of tight labor markets here in Michigan is here to stay for the foreseeable future, certainly relative to the past 20 years. And one reason for that is the state's labor force participation rate, which you can think of in some sense as labor supply here in Michigan. The first thing to point out is Michigan's labor force participation rate fell dramatically over the first decade of the millennium. It did make up a little bit of ground in the years before the pandemic, but it fell to a new low of 59.2% in 2021. We saw some improvement last year with an average participation rate of about 59.9% by our estimate. And we're projecting, you can see a slow recovery, but some recovery from here. We expect Michigan's labor force participation rate to get to an average of about 60.4% in 2025. But you can see that's still well below where we were in 2019. And just the reality is that Michigan's aging population is going to work against the tight labor market to hold down labor force participation in our projections. Moving to incomes now, this slide shows our forecast for Michigan's personal income per capita and real disposable income per capita. And just to tell you what real disposable income per capita is, we calculate it by subtracting personal taxes from personal income and adjusting for inflation. So it's really a useful way to track living standards over time. Looking first at the yellow line, which shows personal income per capita without making those adjustments, you can see that it jumped during the pandemic because of all of the stimulus. We expect that once we have data for the entire year, excuse me, I did not mean to, there we go, sorry about that. We expect that once we have data for the entire year, personal income per capita will basically have treaded water in 2022. So we expect that incomes were flat. Labor income obviously grew a lot from 2021 to 2022, but we didn't have the stimulus in 2022, right? And we did have stimulus in 2021. So that was kind of the reason for the treading water. We do expect personal income to return to growth over the next 3 years, and it actually ends our forecast about 29% higher than in 2019. So that's, good news, but the blue line shows the problem, which is that inflation is going to eat away almost all of those gains. Real disposable income per capita jumped by about 8.3% in 2020, again, because of, the federal income support. But what you can see is that, unfortunately, inflation has basically erased all of those gains at this point. We estimate that real disposable income per capita in Michigan declined by 10% last year. And that's why so many people feel like we're in a recession. If you talk to people who aren't economists, they say, well, aren't we in a recession already? And I say, no, there's this committee that decides whether we're in a recession, and the things they look at say we're not in a recession. It's just that your purchasing power fell by 10% last year. So it's a tough thing to explain to people, and they have reasons to feel like we are in a recession. The good news is we expect Michigan's real disposable income to return to growth over the next few years as inflation moderates. Growth averages about 1.5% per year from 2023 to 2025. And so Michigan's real disposable income per capita recovers to just about the 2019 level next year, and then it grows to about 1.6% higher than that in 2025. So, although our forecast does call for Michigan to avoid the brunt of the national recession, I do want to, say state residents will basically see almost zero growth in living standards over a period of about 5 years from 2019 to 2024. So it's a good news, bad news forecast and situation. As I say, historically, when the national economy turns down, Michigan really, has gotten hit hard, and we're not expecting that to happen the same way that it's happened sometimes in the past this time through. But when you look at, purchasing power and living standards, they're basically going to be flat for quite some time in our estimation. This slide shows you our forecast for state tax revenues split into the general fund in yellow and the school aid fund in blue. In fiscal 2020, combined general fund and school aid fund revenue managed to eke out a small gain despite the pandemic. But then revenue growth just really took off over the past 2 years. In fiscal 2021, combined revenues increased by about $4.2 billion, or 17%. And in fiscal 2022, they increased another $3.7 billion, or 13%. Although I do want to note that the numbers for 2022 could still change during the state's book closing process. And we do see some reasons for the boom in tax revenues. The main reasons we see is that consumer spending shifted sharply from services and towards goods during the pandemic. And goods are much more likely to be subject to sales tax here in Michigan. So that supported sales tax collections. And of course, sales tax is applied to nominal prices, right? It's not applied to inflation-adjusted prices. So inflation will tend to boost sales tax collections. Altogether, over $3.2 billion of the combined revenue growth over the past 2 years came from increased gross sales and use tax payments. And then the second reason for the strong performance of tax revenues over the past 2 years is that we've seen very large increases in net personal income tax payments. And that's consistent with that sharp rise in personal income that I showed you on the previous slide. But I do have to confess that the strength in tax revenues over the past couple of years does remain a little bit of a statistical mystery to us. There's a little bit of extra juice in there that is hard to explain just on the basis of the economics. One thing to say is that the Bureau of Economic Analysis, which measures personal income, they keep going back and finding more income here in Michigan, and so that does help to explain the pattern, but at least based on, the income figures we have right now, tax revenues do seem to be a little bit stronger than we would have guessed, based on historical relationships. With that in mind, we do expect both general fund and school aid fund revenue to fall back partially towards their historical trend this year. The ongoing shift in consumer spending away from goods back towards services and the recent decline in gas prices both will reduce sales tax, while the slowdown in the housing market will reduce use tax and real estate transfer tax. Net income taxes also fall partly back toward trend in our forecast. Combined, we expect general fund and school aid fund revenues to fall by about $2.6 billion in fiscal 2023, or about nearly 8%. Modest growth of about 1.5% returns in fiscal 2024, and then it really picks up to about 4.1% growth in 2025 as the economy recovers from the national downturn that we're forecasting. I do want to point out, though, that even with the revenue contraction that we forecast, combined general fund and school aid fund revenues will remain about $5.9 billion higher this fiscal year than they were in fiscal 2019, and still well above the pre-pandemic trends. With that, I do want to just take a few minutes to tell you a little bit about our longer-term outlook for the state, and I've had the opportunity to present these slides to some of you here before, so I'll go quickly. So sorry if this is a repeat, but I do think it's important information to keep in mind. I've showed you our forecast for 2025, but we do also like to think longer term about the state's prospects. And we've recently produced a report sponsored by the Michigan Department of Transportation that shows our long-range demographic and economic forecast through 2050 for the state of Michigan and each of its counties. I'll just go through a few slides, but the full report's on our website if you want to know more. This slide shows you our forecast of Michigan's population through 2050. And the simple reality is that population trends represent a significant speed limit for Michigan's long-run employment and economic growth prospects. The more people we have, and especially the more working-age people we have, the more job growth we'll be able to sustain as well. Michigan's population reached a record high of nearly 10,080,000 people in 2019, but the state population declined from 2020 through 2022 due to the pandemic. We forecast the population to start growing slowly again this year, reaching a peak of roughly 10,540,000 residents in 2046. I want to be honest with you that the scale here makes it look like more impressive growth than we're really forecasting. If we were starting the scale at 0, it would look like a pretty underwhelming line, right? But in any case, the state population peaks in our forecast in 2046, and then it declines slightly actually through 2050. And the most important reason that our population growth will slow down and eventually reverse in our forecast is what we call natural growth, which is simply births minus deaths. Michigan's demographic fundamentals are going to start deteriorating very soon. Natural population growth in Michigan declines each year after 2024 in our forecast. And by 2040, deaths are actually expected to outnumber births in Michigan, so that natural growth turns negative. And that's the largest driver of our slowing and eventually negative population growth in this forecast. And our slowing population growth and our aging population, which I won't get into as much today, but I'm happy to talk with you about offline, or it has important implications for employment. And this slide shows our forecast of statewide employment through 2050. I do want to point out we use the Bureau of Economic Analysis measure for our long-run forecast. So the history that I'm showing you here looks a little bit different than the numbers I showed you earlier, which uses a different data source. It's the curse of being an economist. But as measured by the BEA, Michigan's employment count reached record high levels in 2018 and 2019 before the pandemic. And obviously, we lost a large number of jobs in 2020, but we forecast that Michigan's recovery should put BEA measured employment almost 2% above the 2019 level by 2024. But you can see, we are projecting decent employment growth in the near term. But we expect employment growth to slow down dramatically after that, especially as we get into the 2030s, when there's really an 8-year stretch when employment doesn't grow at all in our forecast here in Michigan. And part of the story there is that the demographic slowdown I showed you puts a sharp speed limit on how fast we can grow. Just looking a little bit at the geographic detail, this slide shows you our forecast of cumulative, so 30-year population change from 2020 to 2050. And I'm not going to get into all of the numbers, but basically the green colors represent population growth, while orange and red represent declines. We expect Michigan's total population to grow by about 4.5% cumulatively from 2020 to 2050, but you can see the growth's not spread evenly across the state of Michigan. We actually expect 45 counties to lose population compared to only 38 counties that grow. Counties losing population tends to be located along or near Lake Huron, as well as in the Upper Peninsula, where only 2 counties, Houghton and Marquette, are expected to see population growth. The counties with the greatest population declines also, not surprisingly, tend to have higher shares of senior citizens today. The fastest growing counties in Michigan are in suburban Detroit, plus a band stretching across the middle of the state through Kent and Ottawa counties to Lake Michigan, and as well as in the tourist-oriented and retiree-friendly northwestern region of the Lower Peninsula. And I should say also family-friendly. We love getting up there, so. This slide shows our employment forecast by county, and it's probably not going to surprise anyone that it looks pretty similar to the map of population change that I just showed you. But you know, even so, there are differences. It's not a perfect correlation with our population forecast. And you know, maybe the most important takeaway is just, again, we expect more counties actually to lose employment from 2019 to 2050 than to gain employment. The most favorable outlooks are generally for counties with large shares of employment in industries with strong growth prospects, as well as with supporting growth in their working age populations. So just to wrap up, we're forecasting a complete recovery in payroll employment here in Michigan by early in 2024, the first half. But the unemployment rate actually rises to about 4.7% by the middle of next year, following the mild recession that we anticipate nationally. Personal income in Michigan rises to nearly 30% higher in 2025 than it was in 2019. But again, in terms of living standards, inflation is going to eat away most of those gains, almost all of those gains. State tax revenue declines by about $2.6 billion this year in our forecast following the boom of the past 2 years, but it does still remain well above the pre-pandemic trend. We do see the major risks to our forecast as being tilted to the downside. The largest risks we see are inflation proving more stubborn than we project, demand for light vehicles falling sharply, and the pain in the housing sector leading to large job losses in construction. But you know, just to echo what Daniil said, I do think the odds of a soft landing have risen, you know, recently over the past couple of months. We still do see the risks as being tilted mostly to the downside. So with that, I just wanted to say thanks again for inviting us to present, and Daniil and I will be happy to take any questions. Thank you.
Thank you both so much for the presentation. And I was remiss earlier in acknowledging that we have several legislators in the audience, or up here, so welcome. Members of the committee, any questions? Director Harkins.
Gabe, thank you both for being here, Daniil, Gabe. These issues around population are certainly intriguing, and I think we've talked about this a little bit before, but could you give a little more color around what you see both nationally and regionally on those same sort of population issues? I think, you know, certainly this impact, as we look at the charts you've shown for Michigan, are concerning in the long term. They're not new news for us, but I think I'd like to have a better sense of what we look like compared to the rest of the Great Lakes region and some of the rest of the trends that you expect to see. Thank you.
Sure, yeah, thanks, Chris. You know, like you say, it's not new news, and you know, one nice thing about forecasting demographics as opposed to the economy is, you know, people actually do get 1 year older every year. You can kind of, you can get that one right with some confidence. So, you know, we know that Michigan is an aging state. And you know, we are going to see more and more people aging out of the traditional working years. And the pandemic accelerated that trend. You know, a lot of the excess, I showed you the labor force participation rate, it remains below where it was before the pandemic. A large part of that is because of more people being retired than you would have expected, you know, as of 2019. You know, just a few things to know about Michigan and its population trends are that Michigan is a domestic out-migration state, which is to say more people move away from Michigan to other places in the United States than move from other states to Michigan. On the other hand, we do get a lot of net international migration to the state of Michigan. So that is a big source of growth for us in terms of the population, is people moving from other countries to Michigan. And, you know, that is something that I worry about, that, you know, it's underappreciated, that we kind of rely on that as a source of growth. And, you know, that fell off quite a bit from, you know, if you look at, like, say, the 2015, 2016 international migration to where we are now, you know, we lost a lot of international immigration to the United States and to Michigan. So I think that's, you know, a really important factor to keep our eyes on as we, you know, make demographic forecasts for the state. I don't know if that.
I just have a brief national comment. I just want to say that nationally, immigration has been responsible for a large chunk of net population growth over the last couple of decades. And looking into the future, I mean, the projections that we use come from census, but the confidence bands are very, very wide, especially for immigration projections. So if something happens nationally for immigration policy, it'll probably be a benefit to most of the states in terms of increasing the size of the labor force, increasing population, and increasing demand.
I just want to agree that this is always a tremendously interesting set of presentations, so thank you both for joining us today. You know, I continue to try to understand these consumption patterns over the last several years, and I don't know that I have a lot of information to really truly understand it. But I mean, in thinking about, you talked a few areas in the economy where you're seeing some of those backlogs of demand freeing up, both in auto vehicles and in housing. Are you seeing any of those savings, those record savings rates that we saw from consumers that raised, particularly on the upper end of the income spectrum, continuing to support spending going forward? And are you seeing any consumer debt patterns that may be also supporting that spending where you could see some troubling trends going forward?
All right. So just to provide a little bit of color, there are different statistics out there. One of them is how much people still have in their savings and checking account. And that number is huge. There's like excess, I want to say 5 trillion. But if you look at overall financial wealth as of, I want to say the second quarter of this year, which is the latest data we have from the Federal Reserve, the overall financial wealth is probably back on trend, largely because we have seen a very significant correction in equity markets. So even though it's true people saved a lot, they still have some of that on their checking accounts. Their 401ks are hurting. The housing values appear to be sliding. So I think we should be cautious interpreting that the stock of saving out there, whether it's going to support consumption or not, because people are probably going to get cautious because their 401ks are hurting, their brokerage accounts are not doing great, their housing wealth is a little bit threatened. Additionally, I want to say that the stock of checking accounts and saving accounts skews differently by income percentile, and people in the lower fifth of the distribution are actually doing worse than they have been before the pandemic because they probably had to spend a lot because of inflation. So I used to be a lot more optimistic maybe a few months ago, but looking at the latest financial assets data, probably there's still some support because the propensity to save from liquid assets, propensity to consume from liquid assets is a little bit higher than saving from your brokerage account for spending from your brokerage account, but still, it's not going to be a huge driver. That's my best.
Good morning. Always good to hear from you, always a lot of information to try to process and to even ask the right question. But I actually have two. One thing you didn't talk about is sort of corporate profits, and when we talk about this, the state CIT, where that plays into your numbers there. So I'll go with that one first. What do you see there?
Yeah, thank you. So it's nationally, we expect corporate profits to remain somewhat elevated, and it's basically the difference between wage growth and pricing power. So wages have, until the recent data came out, seemed to be accelerating, but the recent revision took that all away. So wage growth is not spectacular, and inflation is still going up. So margins between what businesses charge and what they have to pay in costs is still sizable, so we expect corporate profits to remain reasonably strong. I'll defer the CIT question.
No, I mean, I don't have a lot to add to it. That's precisely what I would have.
So you don't see the CIT coming down, or on your estimate there, you have these drops, but it's not related?
It's not a big, CIT story. It's as I mentioned, it's a lot of, sales, use, personal income, tax.
Since it's 10 o'clock, I will talk to you offline.
Okay.
Is it?
Yeah.
It is 10.
I did have a question. Thank you, Julie Brixey, House of Representatives. So back to the population and the demographic information, can you tell me where the population growth from the international folks was primarily coming from before the slowdown from the pandemic? Is there any particular area that it was stronger from?
Yeah, just speaking at a high level, I think, Michigan's profile of international immigrants is different than some states. We're obviously on the northern end of the country. We're not on the southern border. With that in mind, it typically, one thing to say is international immigrants to Michigan are a well-educated group on average. They are, my recollection is they are more educated than native Michiganders on average. People will come to work in the auto industry, obviously, and, engineering roles, those sorts of things. So I think just where we are geographically, what our industry mix is, means we do get, kind of a different profile of international immigrant than, if you look at the country overall, there's geographic variation. So that's, I think, kind of at a high level.
So it's more tech and medical and STEM based?
Yeah, it skews to be a more professional population. Obviously I don't want to make generalizations about a whole population. You get a wide range of individuals, but just on average, that's right.
I just want to add that we have quality data on legal immigration, but we don't know what numbers and characteristics of illegal people are. So they're probably more from countries physically connected by land, but we don't have good data until they become legal and start answering to the government surveys.
Thank you so much for being here, and thank you for this presentation. Samantha Steckloff, House of Representatives. I wanted to go back to some of the inflation information and the rates. One thing we've seen in Michigan, especially in southeastern Michigan, has been a huge growth within our mortgage industry. With the rates increasing at such a significant growth, we're really seeing that industry kind of crash a little, and that worries me as we look into some of our major companies that are putting so much growth into the Detroit area. So my two questions is, how are these interest rates really affecting Michiganders? Are we going to see these high home prices that people are buying because they think they have more disposable income based on that income growth? Are we going to see a sharp, crisis with people no longer being able to afford those high-priced homes with a higher interest rate? And number two, how are we working with the increase in rates for car prices, loans, and things like that? How are we forecasting that out for the future, since we are seeing that type of growth in personal income is staying stagnant?
Thanks. Yeah, it's an important question. I'll try to touch on a few of the the questions there. One is in the state's finance industry, as you mentioned, it has been a growth industry for Michigan recently. Mortgage finance obviously gets a lot of headlines. It's been an important employer in Southeast Michigan. We do expect some job losses, and we've already seen job loss. You see them in the headlines, so it's easy to forecast in that sense. So we do expect job losses. The finance industry is in the yellow line I showed you in that industry graph, and that's part of the reason for the relatively moderate recovery. And I showed you that those industries have lagged behind the blue collar industries, and part of the story there, and part of the reason for the relatively slow growth or moderate growth that we foresee there is precisely the rise in interest rates and some job losses. We don't forecast overwhelming job losses in the finance industry, but some job losses this year. Moving to affordability, I think you've put your finger on, a really important set of questions. One thing I want to say is partly that's by design. So we do expect house prices to fall nationally, here in Michigan also, but not like we saw in the aftermath of the Great Recession. And, I'm stepping onto Neil's territory here, so hopefully he'll forgive me. But a big part of that is underwriting standards and mortgage quality was much higher coming into this episode than it was before the Great Recession. So we don't expect, unless there's a very severe recession, we don't expect a big increase in distressed sales and distressed supply, foreclosures, short sales. And that was a big part of what, brought prices down. So we expect, thank you, Daniil. So you can see, more
Right.
modest.
So this is what we have for single-family home price appreciation. It's not going to be dramatically more affordable in nominal terms, but we project home price inflation to stay below overall inflation. So marginally, we're going to see some better affordability. And as mortgage rates decline, that will also help, but it's not going to be dramatic. Second point I want to make is as soon as rates start declining, there's going to be an uptick in demand for the financial services because they'll be doing refinancing.
Yeah, and just to clarify my argument about it being by design, the Federal Reserve is trying to slow down the economy to bring inflation in. So, part of the housing affordability has cratered. You're exactly right. It is going to be an adjustment. It's going to, make it harder for some people to get that first house, make that first home purchase. But, that is part, the Federal Reserve is trying to slow down the economy and by raising interest rates. And so that's part of how monetary policy affects the real economy. So, thanks.
I don't know. You had a second part of the question about interest rates for vehicles. Those are shorter-term loans, so it's not going to affect the monthly payment as much. And people who are buying new vehicles are typically fairly well off and elderly. Not elderly. Sorry, they are about my age and a little bit older, but they are typically fairly well off, so they can absorb it. What's going to happen a few years down the road for the used car prices is another matter. And used car prices are collapsing right now, so that should be helping to anybody who's looking into moving like 2-3 year vehicle. And no offense, I'm talking about myself, so.
It's okay. I was going to make a joke about being a millennial and the birthing rates, so.
Thank you.
So much.
Thank you.
Very much appreciated. We are going to turn to a Zoom presentation from Gianluca Benigno on the Global Supply Chain Pressure Index. A little bit about Gianluca, and let me see if I can work this. He's going to screen share, and let me see. Okay, I think Justin's coming up to get this on here.
Yes, hello. Can you hear me well?
I can.
Thank you very much for the opportunity to present our work that we have developed in the International Research Function at the New York Fed. And before I start, I want to put forward the usual disclaimers that what I'm going to say does not represent the views of the Federal Reserve Bank of New York, the Federal Reserve System, or the FOMC. And I'm going to discuss the constructions and the motivation behind the Global Supply Chain Pressure Index, which is a product that we have developed at the New York Fed in the past year and a half. So why we developed this product? I think this is the first question that we usually been asked. And of course, that comes from the complex structure of the production side that we observe in a globalized economy. And I want to first emphasize that this complex structure that is based on a global value chain has been always praised as a benefit of globalization in terms of the efficiency gains that it delivers from a production perspective. But as we have seen in the past year, more than a year, there are also costs. And this cost has been uncovered by the pandemic developments. Indeed, with the pandemic, with COVID-19, we observed a shock that affected the supply chain and also a shift in behavior of consumers in terms of how they directed their consumption, especially during the lockdown period towards, since they cannot consume service, they shifted their demands toward goods. And one question that, of course, we were looking after was what are the implications of these disruptions? And our perspective at the New York Fed was mainly a macroeconomic perspective. So what we wanted to understand was the implication of this disruption for inflation, the implication for this disruption for export or imports as well. But towards the end, I'm going to emphasize also that this kind of measurement issue that we try to address are also quite important if you focus on a micro perspective. So if you focus on firms and companies. And indeed, this is not work we have done, but we can guess that there is quite a tight link between the measures of these disruptions and the firm's profitability, depending on the sectors that have been exposed to these disruptions. Now, what did we do? So when we were looking at all this last year, we started looking at how people measure these disruptions. And one thing came to front of ourselves was the fact that there were a lot of different dimensions that could capture the disruption that we observe in supply chain. And the key idea was to try to measure, indeed, the disruptions that we observed because of health developments related to the pandemic, so the inability of workers to go to work, to the health measures like lockdown measures that basically reduced also the capacity to produce. And as I said, there were different measures that were used to capture the disruptions that we observe as a consequence of these choices and these developments. And our idea was very simple, was to say, okay, every different measures, and I'm going to go over these measures in a bit, try to capture a different dimension of the problem. And our idea was to say, okay, let's try to put all this information together to construct an index that hopefully give us a sense of what is happening, collecting all these different dimensions of the same problem. And in doing that, we basically combine two sources of data. Data coming from global transportation costs, and here we're talking about shipping costs and air freight costs, and also data coming from the diffusion index, as the one that were mentioned in the presentations before. And here we look at subcomponents of PMIs for different countries. And we look at backlogs indicator, so basically measure of orders that have not been completed, delivery times, and purchase stocks, which is a proxy for inventories. Now, our analysis at first, and the one that we also advertise in our product at the New York Fed, is an analysis that look at all of these issues from a global perspective. So we try to measure this disruption by looking at the global economy. And in doing that, indeed, we look at global transportation costs, and also we combine these subcomponents of PMI for several countries that are sufficiently integrated in the production network of the global economy. So we look at Euro area, the United Kingdom, United States, and 4 East Asian economies, Japan, Korea, Taiwan, South Korea, Taiwan, and China. Now, there are a little bit of details on how we construct all this that I'm going to skip because it is not the venue here to go into these details, but just to say that, of course, we needed to combine different sources of data with a little bit of different information, different frequency, and so on. But in doing that, one aspect that is important before showing you what we came up with is to go back to the initial motivation. And as I said, what we were trying to capture initially was the disruptions related mainly to the supply side of the global supply chain. And in doing that, I refer, as I said earlier on, to basically measures from an health policy point of view or developments in terms of the pandemic that were affecting the capacity to deliver or the capacity to produce. So in doing that, one important aspect when we look at all those indicators is to try to strip out, to filter out the demand side, to basically isolate what we refer as a supply factor from each of these components that we use in order to construct our index. And that is what we do as a first step once we collect the data. The second step is to try to filter out this demand component. And in doing that, then we do a statistical exercise in which we extract a component that we call the Global Supply Chain Pressure Index that is meant to capture all the information coming from these different sources. And here we can see basically the development. So this index that we have constructed from the first period in which we could, basically the end of 1997 till the most recent observation that we released last week. So what do we have here? So let me show you, let me guide you through the graph. First of all, the blue line is our index, and you can see how it changes over time. And 0 represents basically the historical average of the index. So when the index crosses the 0 point, it means that it is at a level that is consistent with historical average. When we have the index that move up or down relative to this 0 threshold, we are measuring the standard deviation. So how far this index is relatively to this historical average. So as you can see here, there are quite a bit of fluctuation in the index over time. But what is noticeable, and this is indeed why our index became, I would say, relevant in the current analysis of issues like inflation, is that we see big spike of this index during the pandemic. This is the initial phase of the pandemic in which the index reached 3 standard deviation relatively to the historical average. So this is a big, very big fluctuation. And also later on, during the recovery, and towards the end of 2021, the index reached almost 4 standard deviation. Actually, it was slightly above 4 standard deviation. Now, so these fluctuations were unprecedented, so much higher than the historical average. And here I want to emphasize a couple of other episodes in which we can pin down certain events that could be related to movement in the index. The first one is an earthquake that led the index to reach a value of 1.5 standard deviation. And the second one were tensions between US and China in terms of what was referred to as trade war, in which the index reached a value of 0.82. So as you can see, and this is something I'll discuss in my conclusion, there are different factors that can affect the developments of the index that is meant to capture these supply chain disruptions at the global level. And what is, I would say, interesting here is, as I said before, the fact that recently this index during the pandemic has reached a really high level. So as you can see now, during 2022, the index has dropped, and now I'm going to zoom on it, and you can see that after reaching the peak towards the end of 2021, so this is the index now to zoom out during basically the exactly before the pandemic, and then through the pandemic up to now, and we can see that there's been a significant improvement in the index, but still we are not, we are still above historical average, and our index in the last 2 or 3 releases actually has not improved, and has been slightly above 1 standard deviation. Now, one thing that is important here is to try to understand, how to interpret these movements. Of course, we can say that there's been a big improvement here, and now we see a little bit of a slowdown, and but also we saw a little bit of an uptick at the beginning of the year towards March, April. And what is important is to try to go a little bit deeper behind also the headline number, which is the one that I'm showing you, to try to understand how the different components behave. And this is important because it gives us a sense to the extent to which the improvement is caused by a uniform improvement in all the subcomponents, or is caused by an anomaly or one factor that drives everything. So ideally, let me go back once again to the previous slide. Ideally, when we see this improvement in 2022, what we would like to see is that the improvement is associated with improvement with all the subcomponents. And this is just a little bit of a discussion in what has happened in the last 3 months. So in the last 3 months, we see that the index has not improved. It has been relatively flat at just above 1. And the reason is that basically developments in Asia have driven the index up. So we see that Asia outbound air freight component is up. Also, we see the China, Korea delivery times and China delivery times contributing positively to the index. So each bar here represents the contribution of each component to that number that I showed you before on the period going from October to December 2022. So the period in which the index has been relatively flat, if not moving a little bit upward. I want to show you another way, it's actually another example on how we can read a little bit more into the index. And here I'm going to look at the period going from March to April 2022, in which there was an uptick again in the index. There was more relevant than the current uptick. And we can see here that again, that kind of movement was driven by development in Asia, and in particular in China. And if you go back to that period, March, April 2022, there was the period in which there was a lot of discussion about, it was not a discussion, but there was a lot of issues related to the zero COVID policy in China and the effects that it was having on port congestion in particular. And that's why we saw this uptick caused by China delivery times. Also, that was a period in which the conflict between Ukraine and Russia started, and we see that there was also a worsening of Europe outbound and the European area backlogs that also contributed positively to the development on the index. Now, one thing that I also want to very quickly emphasize is the fact that every time we release the index, we need to, there are revisions that occur. And some revisions are mechanic because, of course, every observation changes the mean. And so we can have, if there is a big movement in the index, we can have revision that go back in time. And also because there are natural revisions that occur in the data. Now, despite that, I would say that our index, and here we have different vintages of the index, the September, the October, the November, and the December one. They are not that different one from the other. So in terms of capturing the trend and what is going on, in terms of what we are measuring, we are not doing big errors as the data revisions comes in. And next, I want to go back to another aspect of a supply chain. So originally, as I said at the beginning, when we were looking at this problem, we were starting to look at this problem because we had a supply side perspective. So our perspective was to say, listen, workers cannot go to factories or there are lockdown measures. And we were trying to figure out how we can measure all these supply side dimensions. So as I said earlier on, in the construction of the index, we filter out the demand. More recently, we said, well, why don't we just also look at what we would have with the same procedure if we don't filter out the demand? And we call these measures the net global supply chain pressure index because it meant to capture the net pressure, so coming from both the demand and the supply side, on the dimension of the global economy, which is the global supply chain dimension that is the one on which we are focusing. So here in this graph, we have the blue line, which is our original global supply chain pressure index. And then we have the red line, which is the net one. And you can see that, sometimes they co-move, so they go in the same direction, and other times they do diverge. And I want to show you why this is interesting, especially when we look at what is currently happening and interpreting also what we are currently experiencing. And to do that, I'm going to zoom out once again by focusing on the period that starts from the beginning of the pandemic to the most recent observation. And what we see here, we see again the blue and the red line that are normalized at the beginning of this period in which we are focusing on. And as you can see here, there are periods in which the two move together, and periods like at the beginning of the pandemic in which there is a divergence. And let me explain to you, or give you an interpretation of how we think about all this. So first of all, we see here that there is a bar, which is this gray bar, below these two lines. And this gray bar represents the difference between the blue and the red line. And we interpret this gray bar as the extracted global demand component. So what we see here at the beginning of the pandemic, we see that our supply disruption measures goes up quite a bit. And this is consistent with the idea that lockdown basically forced lead to a capacity constraint. But at the same time, you also see a very big drop in demand. And overall, this red line, which measures the net pressures, is within historical average because it's below 1 and they just fluctuate around 0. Okay? But as the economy recovers, which is the period going or opening up, which is the period going from the end of 2020 into 2021, we see that these two lines overlap. So basically, the pressures that we have observed at the level of supply chain were all coming from the supply side, not so much from a demand, because demand is not, which is this gray bar here, is not that big. But we can see here in the recovery phase of the index, we see that there is both a decline in demand, but also we see a contraction on the global demand side. And this contraction in the global demand side is leading the net supply index to be below 0, so in negative territory, so means below historical average. Now, after presenting all this, I just want to discuss briefly with you how we use it. And our original focus when we start thinking about it was to think in terms of inflation, because there were components in CPI that were mentioned earlier on that spike up quite a bit, like the used vehicle component and also the new vehicle component. And some of these spike was associated also with the impossibility of getting chips. And the idea we had was to say how, for example, we can use what we had just constructed as a measure of this disruption from a macro point of view to address and give us an understanding of the inflationary development that we started observing from mid-2021. And of course, this is an important question in terms of, not just looking at the numbers, but also in trying to provide an interpretation of the number. And the interpretation of the number means that we need to make an assessment in terms of what are the determinants of inflation. Are the determinants of inflation coming from the local side, so the US economy, or they come from a global developments? And also we want to understand at which level these inflationary pressure arise. So are there supply side, are they demand driven? And so this is important, of course, because these can give us guide on how eventually to design policy. Now, in a staff paper report, we do an analysis of all this, but I want to show you just a simple inflation decomposition by using a simple model that we have developed to look at different inflation measures and how different components have played a role during the pandemic and up to now in terms of explaining inflation developments. And let me guide you through this analysis. So here we have three different measures of inflation. The first one is producer price inflation, and this is the measures on which we expect our index to be more relevant, because of course those type of supply chain developments on the supply side and the global side tend to matter most at the level of producer level. And then we have consumer price inflation, and consumer price inflation, this is the first one, is the headline number, and the second one is the goods part, which is the one that is currently declining quite rapidly in terms of inflationary pressure. So what we can see here, of course, our model is not a perfect description of what we observe. We try to highlight what are the factors that matters, what is contributing to positively or negatively. And here, let me just go, for example, in explaining the PPI. So we see here the number of the PPI. So this is the black line. So we see how it goes over time and currently is in negative territory, starting from mid-June, so basically from June 2021. And here we see what are the contribution coming from different components. And our global supply chain index is this red one. And we can see that originally it plays quite a big role in driving up producer price inflation, along with the oil supply one. So this is another factor that has mattered quite a lot in explaining what has happened to inflation. So this is the yellow component. And we can see that as we have seen now improvement in these measures of inflation, this has been driven quite importantly from our improvement, from the improvement that we measure through the global supply chain pressure index. And here we can see also that the global supply pressure index matter the most for producer price, also matter quite a bit for consumer price inflation at the level of goods prices. It matter less when we look at headline CPI. So we see here that in the run-up of consumer price inflation, that the global supply chain pressure index is a positive contributor, but less than what it would help in explaining consumer price inflation at the goods prices. So this is a very simple way in which we could use our index to understand and address the roots of inflation developments. So I just want to briefly summarize here what we do and what I want you to, what is the key message of my presentation. First, what we have done here is we developed a measure to assess what is happening in terms of at the level of global supply chain. We originally look at all this from a pure supply side perspective, but more recently we are also measuring what's happening in a net sense, in the sense that we also keep into account the relative strength of demand and supply side developments in understanding what's happening at the global supply side. Now, what is interesting is the following, is that most of the time, as I said at the beginning, we took for granted and we praised the benefits of these global supply chain developments. But the pandemic and what we have observed recently have actually opened up this box in terms of thinking also at the cost that comes from this allocation in terms of production network. And there are, of course, risks and possible events that can affect supply chain operation. And here I list some, of course, geopolitical, and I briefly discussed those when I was looking at the period when the war between Ukraine and Russia started. Climate events are also important, and possibly also cyber attack, and hopefully not, but other health developments could affect the supply operation. So it's important to keep that in mind. That is useful, hopefully, tool to measure what is happening. But going back also to what I mentioned at the beginning, so we look at all this from a macro point of view, but of course, this type of tool can be useful from a firm point of view in terms to try to measure by looking, for example, at how firm sales are exposed to supply chain development. And our index provides a way to measure all this. From a firm point of view, it's a measure of risk, for example, and I think that is important. Our perspective at the New York Fed has been more in terms of macro point of view. And for us, it was a matter of understanding how these developments affect macroeconomic developments. And I mentioned, and I used the example of inflation, but of course we can use it also in terms of thinking about export and imports, as I said before, and also in terms of industrial production. And what we are doing next is that I show you already one refinement in terms of the original analysis, but also we are looking for more data. And we want to get a more precise way to measure all this by using, for example, data on port congestions that we currently don't use, data on shipment that we currently don't use. And part of the refinement is also aimed at measuring the supply chain disruption, not only from a global point of view, but also by looking at single countries. So we have already developed 7 indexes associated with each countries that I mentioned earlier on. So we have also an index for the US, we have an index for UK, Euro area, China, Taiwan, South Korea, and Japan. And the idea is to get more information, hopefully, to make this analysis more precise, to also understand how things can be related to each single country index developments. And I want to thank you for your attention, and I hope you found this of interest. Thank you very much. And if you have any questions, of course, I'm very happy to address them.
Can you hear me okay?
Yes.
There might be an echo. Thank you so much for your presentation. This was very interesting. I think we hear a lot, in the United States, but not as much on this type of thing. And I think it's an important, something that everyone has been hearing about, supply chain issues and how they're affecting us. Are there any questions from the committee? Sounds like we do have a question from Director Cleary.
So it was a lot for me. So the question I have was, so am I to take then the supply chain constraints sort of have eased overall Is that first fair to say?
Sorry, I couldn't hear the question well. I apologize.
Did you hear the question? Okay, sorry. So my question would be, so the supply chains overall have sort of eased based on your charts. Is there a specific sort of choke point that we need to be aware of on one of the, some of the products coming across?
So I think I got the sense of the question, so I apologize if I don't reply exactly, because there is, I don't know, there is maybe some echo that for which it makes me a little bit difficult to hear perfectly. But so yes, the supply chains have eased, and they've eased quite rapidly, I would say, coming down from the 4 point something at the beginning of towards the end of 2021 up to now. Now, what we are saying is, in our analysis, especially when we look at the supply side dimension, that is the one that seems to be more relevant. For example, when we look at inflation, and this is what I was trying to show earlier, is of course there are issues looking forward, and I would say that one of the biggest risks that we have emphasized also more recently in one of our blog is risks coming from China, developments in China. Now, overall, it is fair to say that China contribution to what has happened at the level of global supply chain has not been that dominant, contrary to what you might expect. It has mattered a lot at the beginning of the pandemic. It has played a role at the beginning also of the year in March, when I mentioned earlier on. But the current developments that we are observing in China in terms of COVID could put further strain in terms of what can happen to the global supply chain pressures. And this is I think I would say the biggest risk that we see currently in terms of the development of our GS CPI towards historical average. So, but still, despite the improvement, we are still above, quite above the historical average, because the index is still above one standard deviation. So this is consistent with what was earlier presented. So there are still disruptions that are occurring, and they're not as as big as a year ago.
Thank you.
Yeah.
Are there any other questions? Nope, I think we're done. Thank you so much again for being with us.
Thank you.
Appreciate your time.
Thanks a lot.
Thank you. All right, and now we are going to bring up, we're going to move to the Senate, House, and Administration Economic Outlooks and Revenue Estimates. This will be David Zinn from the Senate Fiscal Agency, Jim Stansel from the House Fiscal Agency, and Eric Busses from the Department of Treasury. While they are coming up, I want to take this moment to thank the staff. I'm sure we all will at turns, but thank you for all the time, hours, weeks, days, months, constant, year-long monitoring of what you guys do. We really appreciate it.
Well, good morning, everyone. I'm Jim Stansel with the House Fiscal Agency. David Zinn is to my left, and Eric is all the way down on the left. And that's pretty much the order in which we'll go today. So I'll start out with just looking, a very brief look at our economics from our respective forecasts, and then take a look at a little bit at 22 revenue, which I think we've heard something about over the last week or two. David will then start looking at the major taxes that we focus on in our various forecasts and seeing what the trends are there. And then finally, Eric Busses from the Department of Treasury will take that information and talk about the school aid fund, the general fund revenues, as well as some of the other required items like budget stabilization fund and constitutional revenue limit. So this is just a very brief, 50,000-foot view of our economics, kind of from our various forecasts. And you've heard most of this before. This dovetails very closely with what Daniil and Gabe were talking about. Our kind of respective forecasts would look at relatively flat growth in 2023, gradually increasing in 24, and a little bit more robust growth in 25. Inflation currently high, I mean, that's high as a normative term. For those of us who were around in the late 70s and experienced 13.3% inflation, 6.1 doesn't sound quite so bad, but certainly in terms of more recent history, it's clearly something the Fed is trying to attack. But again, all of our forecasts see inflation kind of starting to abate beginning in 23 and stepping down to about 2.7% in 25. Gabe told you a little bit about and Daniil about the light vehicle sales. After closing off 2022 down 7.7%, we're expecting them to jump by roughly the same amount in 23 and then increase at about 5% in each of 24 and 25, ending up at around 16.4 million by the time we get to 25. And so that's, that's, as Gabe pointed out, certainly not the 17 plus million where we were pre-pandemic, but well above the levels we were seeing in 20 and 21. With respect to the Michigan economy, we're looking at it to pretty much fall in lockstep with the national economy. The unemployment rate in Michigan will trend a little bit higher through the out years, especially 24 and 25, maybe by about 0.3%. But for the most part, we're not going to see a large difference between what's happening at the national level. Similarly, with wage and salary income growth as well as employment growth, we're very much in line with what Gabe was pointing out, that we do see employment and wage growth continuing in Michigan over the forecast horizon. This chart shows kind of our respective GDP paths, starting with the fourth quarter of 2004, and kind of what our own individual outlooks were as we look at the Fed raising rates and what impact that has on real growth. And while there are differences in duration and also the degrees by which by which the forecasts have drops and then increases, they're not substantially different. They're all there's a relatively moderate band that all are following. The administration and Senate fiscal both have three-quarter recessions. Senate fiscal starts a little bit more quickly, drops a little bit more deeply, but then recovers more. Department of Treasury starts a little bit later, having growth in the first quarter of 2023, whereas the House and Senate are showing negative growth to begin the quarter or to begin the year. But then dropping and coming back a little bit more slowly. House fiscal is showing a two-quarter recession that's fairly modest at about 0.5% down, and then growing from that point on. So with a small blip in the fourth quarter of 2023. So we don't have large differences in our respective forecasts, but this kind of helps to explain to some degree why maybe our outlooks are a little bit different and what the timing of things might be. So as far as revenue updates are concerned, we did end up with 2022 preliminary revenues. Again, we don't have final in yet, but the school aid fund is in at about $500 million higher. And GFGP is in about $1 billion higher. So we have $1.5 billion that we weren't really expecting. Now, a good portion of that comes from the sales tax. It was up about $485 million from May. And, we've heard already about a lot of the reasons that there has been continued growth in the sales tax, but that's exactly what we've experienced. Revenue from withholding is up by about $100 million, and that's, revenue in the door, so to speak. Corporate income taxes, both Gabe and Daniil talked about those briefly, and profits are continuing. And so we are, we're reaping the benefits of those corporate profits to the tune of about, $200 million. And if you look at just these three, those account for, more than half of the $1.5 billion that we expect to be up, at least as far as the preliminary figures are concerned. Diving a little bit more closely into, what those patterns are, if you look at the historical trend, and this is now combined sales and use, not just sales, but sales and use. But, throughout the decade from 2010 to 2020, for the most part, the combined growth rates didn't deviate much beyond 3 to 4% per year. Yet there's the brief jump in 2018, but then obviously it drops off pretty quickly afterwards, especially between 19 and 20 as we head into the pandemic. And then, to no surprise, it jumps very rapidly in 21 for all the reasons we've already heard, the income support, the fact that people are staying at home and buying goods rather than services, and all these things we've heard in previous revenue conferences. And when we were here in May, we thought, well, that can't continue. We've got to bring sales tax revenue down. And we did. We brought it down to, our estimate was 7.2% growth for 22, which would still be the second highest growth rate over that time frame. And we were wrong. It ended up being 11.2%. We thought we were being conservative, and turns out we weren't. So that's just, when you see an increase like that, that's what attributes to that, 485, almost 500 million increase in sales tax that that was above and beyond our projections. With withholding, there's obviously a little bit more volatile growth here. It doesn't follow quite the same pattern that sales and use tax did. But again, after it grew in 20, again, because of a lot of the government support, tapered off a little bit in 21, and we thought, well, it should continue to grow. We still have strong employment growth in Michigan, relatively strong. Wages are growing, and so we would expect withholding growth. And we've forecasted 8.2%, and it looks like, at least based on the preliminary numbers, that it'll be closer to 9%. So again, that's the reason why withholding was up about $100 million over what we were projecting back in May. And this last one looks at the kind of the business tax sector, combining the CIT and the MBT, but we're excluding the impact of the certificated credits. So those are not factored in here. We're just looking at the revenue from those two taxes. And so as you would expect, there was a drop between 19 and 20 of just under 12%. Again, that's showing the effects of the pandemic and the lockdowns of businesses and things like that. But 45% growth between 20 and 21, and another 23% growth between 21 and 22. So over that time frame, that's, we're at $2 billion for the first time combined. And over those last 2 years, it's essentially doubled. I mean, very, very close to doubling combined business tax revenues. And again, strong corporate profits, but it's just something that we didn't see coming in that strong. So last but not least, we've done this kind of chart before with other taxes, but this just shows our various estimates of fiscal year 22 combined school aid and GF revenue, starting back in January of 2020, the first time we did it, and then each revenue conference since then. And back in January of 2020, we were at 26 plus billion. The pandemic hit. We had revenue conferences in both May and August, and boy, we knew it was going to be lower back then. So we brought the estimates down in May, up a little bit in August as we're starting to see some of the stimulus money flow in, et cetera. And as we go through 21 at the two revenue conferences, we bring it up again. And by May of 21, we're actually above our original January 20 estimate. Well, okay, that's fine, I guess. We oftentimes revise these things upwards as we go. But then as we move into January 22, again, we're increasing it. And if you look at the growth rate between 22 and the preliminary final for 22, January of 22 and the preliminary final, that's about a 15.8% growth between January of last year, when we weren't sitting here last year, but we were waving on the computer screen, and where we are now. And if you look at May, where we were sitting here last year, increasing from about $31.5 billion to $33 billion, that's the $1.5 billion gap that we're talking about right now. I was trying to think of a way to say this without trying to sound too glib, but $1.5 billion is a lot, but it's 5% of $33 billion. In other words, in May, we were 95% right, but it was just that remaining 5% we were off on. So I've lightheartedly made this comment before, but if I get a 95 on the exam, I want an A. So it's easy to look at $1.5 billion and say, boy, did we miss that one. But in terms of the actual magnitudes, it's 5%, but just on a really big number. And so, as I said, that's kind of my mea culpa, I guess, is that we thought we were pretty close. So with that, I will turn it over to David.
Thank you very much, Jim. I will cover what's our forecasts are of some of the taxes that Jim just finished talking about. Initially, most of these graphs will talk about first baseline revenue and then net revenue. Basically, baseline revenue is what should be reflecting the economics. And so when you have tax changes that create changes in revenue from year to year that don't reflect the fundamental economics, we'll look at those in net numbers, but we want to look at a relationship that's going on with the economy. And for the individual income tax, the biggest ones are things like federal tax reform, obviously. It changed, COVID and the CARES Act and stuff changed a bunch of provisions, and that affects things. We've also got indexing that goes on because of inflation with the personal exemption. And we have a whole variety of adjustments that you heard more about last May related to the implementation of the flow-through entity tax. And those things cause changes in the net revenues that really don't reflect the economics. It's what's going on with the law. So if you look at our forecast, you can see that there's considerable variation here, particularly in 23. SFA is a lot lower. Our forecast looks a little more like RSQEs from that respect. And the flip side, like Jim mentioned, is because we have a greater decline earlier on. We have stronger growth later in the forecast in FY25. Interestingly enough, most of our forecasts were relatively similar in terms of withholding, which is the overall majority of income tax revenue. Where we had big differences related to quarterly payments and annual payments in terms of how much of the boost we got in 22 actually would move forward. And a lot of those components are made up of things like dividend payments, interest payments, capital gains, and those have a less strong relationship between the economy and relate to when people decide to sell stocks, for instance. Or am I going to hold or buy or sell or whatnot? And it can create timing differences, and to Jim's point, a small percentage change produces a lot of revenue in terms of the differences. So for the individual income tax, when we differ by about a percentage in growth, that's about $130 million. So it produces some big numbers in terms of differences between our forecasts when we have actually not that big a differences. And you can see here, because of those quarterlies and annuals, in 23 and 25, we particularly have different growth rates expected. In terms of translating that to net revenue, we're a little bit closer, but there's still quite a bit. We all have declines in =22. We all have growth in the out years of the forecast. The spread narrows from about $1.5 billion in '23 to about $1 billion in '25. To Jim's point, in the context of total GF and school aid fund revenue, these differences are actually less than about 5% of revenue. So while it looks like we've got big differences, you know, we're all trying to get the A, so to speak. The nice thing is, you know, this is the January conference. A lot of that certainty reflects quarterly payments and annual payments, and by the time we meet again in May, we will have had 2 more quarterly payments, one on a new tax year, and we'll have annual payments. So with fingers crossed, we might have more information to add a little bit of certainty to '23 when we get together in May. In terms of baseline sales tax revenue, you can see the pretty phenomenal number that we had in FY22. You know, as Gabe mentioned, you know, inflation raises sales tax revenue because it's a nominal tax, but we weren't looking at inflation of 14% last year. So people have definitely paid more because of inflation, but they've also paid more because they're just buying more, and it's been pretty strong growth. Consumption tends to be less volatile than those non-economic income components that we talked about, so you can see that there's a lot more similarity to our growth rates going forward. And the differences between these largely relate to our assumptions about some of the things that you've already heard about. Different assumptions about what's going to happen with inflation, and like with Dr. Benigno's presentation, even how the supply chain things affect, you know, there's a bigger effect on goods than on services. And so as this shift goes from, you know, returning from goods consumption that's been overemphasized to services, as we have different assumptions about how that happens, and, you know, inflation is also going to affect that differences as well. But many of these reflect the underlying trends that we had in our economics in terms of the timing of when we think slowdowns will happen and how they will affect. And once again, you know, big bases, so small percentage changes produce large revenue numbers. Each 1% is about 110 million. So if you looked at like the FY23 spread between HFA and Treasury, that's going to equate to $265 million. So it's not a big difference, as you can see visually in the graph, but it adds up to a fair amount of money. When you do look at the net revenue numbers, this is like the graph that Jim had, combined sales and use, our 2 main consumption taxes. They're basically complementary. We all have things relatively unchanged in FY23, so not a lot of movement there. And the spread ranges from about 360 million in FY23 to, as we move forward and things get a little more uncertain, we're at about $1 billion by FY25. Again, this is, you know, not a large part of total revenues. You know, we're now looking at 3%, so we're scoring 97, I guess, between our ranges. If you put all of this together with the previous one, income tax plus sales and use, you're talking about 80% of GFGP and school aid fund revenue. So it's kind of driving the overall numbers between these two. Looking at historically, you can see what's gone on with sales and use tax revenues since Proposal A, and we had a world that actually did a fairly nice trend. We had a little dip in the 08-09 recession like you would expect. And you can see how that shift that was talked about earlier, particularly for goods consumption, really pushed sales and use tax revenues above trend with FY21 and 22. The average of our forecasts are all well above that trend. In fact, if you were to take the most pessimistic ones that we just showed you, they're still well above this trend. So, you know, we all still think that we're getting a lot of growth. It's just trying to figure out how much. You know, kind of like the problem that Jim talked about with our forecast. We all thought sales tax would be down. How much is the big question, obviously. In terms of business taxes, we all kind of largely differ basically because of CIT. You know, the credits are largely locked in by credit and by agreements, and as long as, you know, the economics support them continuing to claim the credits, they're fairly predictable. You know, the only issues are when they claim, and we've got a process that seems to work pretty well at this point for figuring that out. So what you see in the differences here are differences in assumptions about corporate profitability and how that'll move forward. All the agencies have lower profits over the forecast and revenue that would be below what we got in FY22. The spreads here are from about $150 million in 23 to about $100 million in 25. If you were to compare this to Jim's total number, it's literally rounding error. It's like 0.5% in terms of stuff. So while it's a good chunk of change, it's not a significant source of difference between our overall estimates. And finally, net state education tax revenue. A lot of this is driven by growth in taxable values, which is primarily linked to inflation. You know, we have a big, large base of existing housing, and what goes on with the housing that's not sold and isn't new relates to inflation. And so all of us have the forecast rising over the forecast years, mainly because inflation is rising. The differences here reflect different assumptions about how much housing will be impacted in terms of both sales of existing homes, because that affects the bump up that happens when it happens, and what happens with new construction, because you're going to go from a vacant lot to something that's worth a lot more, and if housing construction slows down a lot, that's going to have an implication. But we do think that there's going to be growth. All of these would be all-time record highs for state education tax revenue. And the differences actually you know, are pretty small. In the first year, we were 40 million, but, you know, guessing housing going out, there's obviously a lot more uncertainty, and so our spreads obviously widen as you move to FY25, where you have more uncertainty. And that will wrap up mine, and Eric will tell you about how this affects the funds.
Thanks, David. So I'll take us the rest of the way and take the revenues that David presented and put them into our major funds, and then talk about the statutorily required calculations for this group. So we'll start with general fund, general purpose. As you might expect, based on our revenues, we all forecast revenue in GFGP falling from the historic highs that we had in fiscal year 2022. So about 60% of our GFGP revenue comes from income tax, and as David outlined, we have slightly different outlooks for how that tax will perform over the next year, and that's driving a lot of the changes you see here in GFGP. So preliminary fiscal year 22 is, as we mentioned at the beginning, about $15.2 billion. Going back roughly 5 years, you know, that's about $5 billion more than what we had you know, just in over the last 5 years. So we all forecast that coming down from historic highs, but still being at quite a high level. In the first year, Senate fiscal has the year-over-year decline a bit more steep than House and Treasury estimates. Senate has it dropping about $1.5 billion. House fiscal has it dropping about $300 million, and the Treasury numbers have it down about $75 million year over year. From that initial drop moving into 2024, we all somewhat have similar outlooks from our initial 23 number. So we all forecast that by a between 1.5 and 2% increase from our own numbers. And then moving out, the Treasury number slows a little bit more just due to our economic forecast. And as Jim outlined in the first slide, or the first couple slides, the SFA numbers are a bit stronger growth year over year in 2025. Moving next to School Aid Fund. School Aid Fund also had a record year in 2022. And just for historical perspective, about 5 years ago, that was about $13 billion. And we're looking to close fiscal year 22 at about $17.8 billion. For our outlooks, about 60% of School Aid Fund is from sales tax and state education tax are set. And as David outlined, our outlooks for those are a bit more similar than they are on income tax. So these outlooks for school aid are in a somewhat tighter band. Senate fiscal forecast in the first year, this will drop about 765 million. House fiscal estimates this will fall from the historic high by 83, and Treasury is about flat, just about 1.6 million down. And then going to the out years, it really follows our economics again. Senate fiscal's still a bit slower, and House fiscal and Treasury are up about 2 or 3%. And then we're all about 2% up in 25 from the reset baseline that we each have in 2024. The next slide shows you all the details. I'm not going to read through all of this, but for the budget folks in the room, the last few slides talked about year-over-year changes and where we go from the historic highs we had in fiscal year 2022. But from a budget perspective, we also care about what the change is from the most recent consensus estimate. So the bottom of this chart shows the differences from the May conference. Although we may all have a drop year over year because we had such a good surprise in revenue in fiscal 22, the House Fiscal Agency and Treasury estimates still forecast an upward revision from those prior forecasts. So the numbers are listed here. Senate fiscal still down from May by about 400 million in the first year and about 800 million in 2024, whereas House fiscal and the administration are both up over well over $1 billion from May with these most recent estimates. So the next slide outlines something that's a bit new for this group. We've talked about the income tax rate trigger and the statutory definition that was added in Public Act 180 of 2015, and we've estimated that previously, but this is the first year that this body is charged with making the calculation for what that tax rate will be moving forward. So the calculation is a bit complicated, and we'll run through it at a high level. But beginning in tax year 2023, the income tax rate will be reduced if general fund, general purpose revenue growth exceeds amounts defined in statute. So in the first year here for tax year 23, the way the calculation works is we look at fiscal year 21 revenue and adjust that by the cumulative growth in inflation and a statutory factor of 1.425 and established a capped general fund revenue for fiscal year 22. And from there, we have to adjust the income tax rate to make sure that we're still still below that capped revenue amount. However, since the financial statements are not yet done, as you've heard us mention, we're all working from preliminary fiscal year revenue statements. That calculation can't be done yet. So we can't adjust the revenue or income tax rate in this conference. But the calculation and rate determination will be made by the principals after the publication of the annual comprehensive financial report. Moving next to the calculation for the Budget Stabilization Fund. This is, again, a statutory formula that suggests when the state should either pay in or take payouts from the Budget Stabilization Fund. These are suggestions from the statutory formula, and they still need to be appropriated, and they can be appropriated even if the formula suggests that there shouldn't be one. However, right now in our forecasts, the formula looks at real personal income and the change in that and suggests when the economy is expanding, we should be paying in, and when it's contracting, we should be paying out. In our forecast, we have kind of the middle of the road forecast, and we're right in that middle place where we're not forecasting the formula would request any pay-ins or payouts. One of the final calculations we'll run through is the calculation of the constitutional revenue limit. This limits revenue to 9.49% of personal income. The chart here shows the agency averages for the 4 years of the forecast and where we expect that to be. Just to help provide some context to the chart here. So what this means is, when state revenue grows slower than personal income, we fall below the constitutional revenue limit. And you can see from about 2001 to 2020, we were well below that, and in fact, we were in most years accelerating and continuing to fall farther below that. You can see in 2021 and 2022, years of record revenue growth. We closed that a little bit, but we're still over $7 billion below the constitutional revenue limit. In each of our forecasts, we all forecast, modest economic growth and slower and falling revenue growth. So we forecast that we'll move farther away from that constitutional revenue limit. Just in closing, with any forecast, an economic forecast, there's risks, both positive risks on the upside and risks that revenues and the economy may fall short of the forecast that we've presented here. This is especially true in this conference. As you've heard from RSQE and in our economic outlook, we do expect a recession in the next year. However, the size and magnitude of that is certainly unknown at this point. The biggest risk to the outlook, in my estimation, is monetary policy and the timing and severity of Fed funds rate changes. We've also lived through the last couple of years of supply chain and international conflict, and if those continue to mediate, we might be okay. But if those flare up, we could have risks that would derail the economy. The big risks around Michigan tax revenue is the historic revenue growth that we've had. We've seen record spending, and some of that's certainly driven by inflation. But as David mentioned, we've seen spending far in excess of what inflationary increases would be. So how and when those reverse and when revenues return to normal, and if this is the new normal or if it's at a somewhat lower level, those are certainly risks to the outlook. And with that, we'll turn it over to you for any questions.
So I guess I can ask all three of you. So what is it you're going to be monitoring really in the next 3 to 4 months to see where the economy is? What are the sort of the couple things that you look at, good, bad, that will make you change your mind or not change your mind?
I can jump in. I would say, certainly inflation, consumer sentiment and consumer spending. Over the last 6 months at least, we've seen a huge divergence between how consumers say they're feeling and what they're actually spending. So we'll see if one of those normalizes, whether they start to feel better or whether spending comes back down to earth, or what we've historically assumed is the trend. And then on the tax side, I'd say, as David mentioned, quarterlies and annuals, we're going to have a really good look at what the income tax revenue may be.
Yeah, just to add on a little bit to that, although I'm not sure how productive it is, but one of the things is we were looking at revenues through 22, and every month as we were looking at the cash collections, and it was, wow, sales tax beat the target again. Wow, sales tax beat the target again. And so from kind of an end user, sales tax obviously builds in all of the things Eric was talking about with consumer sentiment and household balances and things like that. When you look at the bottom line, what is sales tax going to be doing over the next few months? And is it going to be holding to what we would expect our targets to be? Or do we see it tapering off a little bit more than we expect? And in which case, maybe we come back and revise downward in May. But, you know, those would be the things. And to a lesser degree, maybe withholding, but that would give us some indication maybe about employment growth and also wage and salaries, especially as we're heading into some kind of presumed downturn, whether it's 2 quarters, 3 quarters, and whatever the depth might be. So I think those would be the indicators that we would see most quickly.
I think the only thing I would add, you've seen in earlier conferences, we've kind of shown that there's this long-standing relationship between certain things like wages and salaries, wage and salary employment, and what goes on with the taxes, and that there have been pretty substantial breaks in recent years. And we keep coming up and telling you those breaks aren't sustainable. They're gonna end at some point. And it's kind of like the question that you asked RSQE earlier. You know, there's still enough mitigating factors out there that, you know, do you spend the balances or do you feel less wealthy because the stock market's down and the media is telling you we're entering a recession and stuff like that. And so, yeah, it'll, you know, the money comes in, most of the money comes in from very few sources, and that's literally what we'll be watching, you know, because that'll be a measure of how people are adapting to that dilemma of savings versus net worth, or do I think I'm going to have a job, and stuff like that. So.
Thank you all. I'll give you A's as long as you keep projecting increases. I think we see in particular in that first chart with the quarterly real GDP that all three are projecting some degree of mild recession going forward. And I believe that's the first time we've seen that out of the collective, or maybe, right? Could you help quantify that? I think for those of us who remember the recessions in 07, 08, this is very different in terms of what you're projecting, but I want to give you an opportunity to maybe help quantify that difference so that we understand that this is really kind of a mild blip in terms of what these projections look like.
Oh. Go ahead.
So I think I'd build on what Gabe said earlier in terms of partially because of the differences of what's going on with the vehicle sector vis-a-vis the national economy. You would expect to see Michigan kind of relatively, you know, not do as bad. You know, Gabe mentioned that, you know, the U.S. gets a cold and Michigan gets pneumonia, sort of thing. We're not expecting that, and I think the economics are consistent with that. Similarly, you know, consumers do have more sitting in the bank, or at least a portion of them, and that helps smooth consumption. Businesses have a lot of back orders. It's not hard to talk to businesses that say, you know, we can run for 2 years at this level because of what people want, and those things will help make it mild. From the viewpoint of, you know, you hear us talk about real estate falling apart and it's in a coma and all sorts of stuff. It's easy to feel like it's 08, 09 again. But if you look at, you know, if you were to pull up Gabe's number about what happened to jobs there, and if you were to break it out by sectors, in 2000 we had over 350,000 transportation equipment manufacturing jobs. We have about 180,000 now. We'd literally have to wipe out every single transportation equipment auto job in Michigan to have the same type of drop that we had during the 2000 to 2010 period. And that's just not going to happen. I mean, all three auto manufacturers are not going to not only cease to be in business, but nobody will take over anything that they're doing, you know, and so yeah, you're just not going to have those types of declines. There's just not any type of fundamental that supports that, no matter what the Fed does with interest rates.
Thank you. Sarah Anthony, Senate Appropriations Chair. Mr. Harkins stole portions of my questions. In 2007, I was a young staffer out there listening and literally shivering at the economic outlook. And here we are now, and although it's January 13th, or February, or I guess it's Friday the 13th. It should be a very scary presentation, but but it doesn't seem to be as jarring. And so the question I had was definitely, Mr. Harkins, was around clarifying and quantifying what that means in terms of our immediate outlook. And for those of us who will be looking at the budget, this presentation is particularly helpful. It always is, to give us a snapshot of our immediate challenges and opportunities, as well as the long term and the level of responsibility we need to have. So not a question, you know how politicians are, more of just gratitude for actually giving us a little bit of a roadmap for the next couple of months ahead. So thank you.
All right, seeing no other questions, thank you again, and to the rest of, the rest of the staff that I know you all work with as well, so thank you. All right, our final presentation this morning is on estimates of K-12 pupil membership and the foundation allowance. So we will have Ryan Bergen from Senate Fiscal, Jacqueline Mullen from House Fiscal, and Beth Bullion from the State Budget Office. And I believe that the presentation is loaded, that Andrew's finding. I also have copies that I will hand out to the principals.
All right, is there, oh, there we go. There. So I had to learn how to zoom in on presentation mode, all right? Hi, thank you for having us. Yeah, I'll be quickly presenting the updated consensus pupil estimates. There's not a dramatic change from May, but the school year 22-23 forecast was revised up approximately 900 pupils after the fall 22 pupil count came in slightly higher than forecasted. Just for reference, the fall count represents about 90% of the pupil membership blend, and then 10% of the blend is from the previous February. So because of this, it led to a slight upward revision of the forecast for 22-23 or 23-24. And that also impacted our forecast for 24-25. The general trend of the forecast continues to show the decline that we've seen for the last 20 years, where generally each year there's a decline in total pupil membership, with local districts continuing a decline and generally a slight increase in membership for public school academies. The decline is projected to be slightly less than what we had projected in May due to the higher fall 22 count. One piece of history that no longer shows, because it's just far enough back, it's not on our forecast anymore, but enrollment did drop significantly in school year 2020-21 during the pandemic. It is still below the pre-pandemic trend. One of the difficulties with the forecast is that it's not known how many of the pupils who left the public school system in 2021 will eventually return, or when, but as they re-enter the system, it does reduce the normal year-over-year declines in membership. Generally, those declines are aligned mostly with birth rate trends. So with all of those caveats said, I'll just very quickly go over the numbers. The new forecast for 22-23, local districts, we're projecting 1,249,300 pupils and 150,500 for PSAs, for a total membership of 1,399,800, which would be a decline of 5,283 from the previous year. The new forecast for 23-24 is 1,243,300 for local districts, steady at 150,500 for PSAs, for a total membership of 1,393,800, or a decline of 6,000 from the updated 22-23 estimate. And this is our first forecast for 2024-25. Local districts are forecast to decline to 1,237,600, and PSAs are forecast a slight increase to 151,000 for a total membership of 1,388,600, which would be down 5,200 from the updated 23-24 estimate. Also, non-public dual enrollment costs in the Treasury budget is just forecast to maintain at $3 million, and, oh, I bet you can blow this up there. Based on the revised pupil membership estimates, we've recalculated the pupil membership adjustment factor. The new factor for 23-24 is estimated to be 1.0043, and the factor for FY 24-25 is estimated to be 1.0037. With that, all three of us are available for questions.
You get 100% for your revision. Forget the 90.
Recalculated.
Recalculated, it's
Point
0.0006. You did great.
So thank you for touching on the trends, kind of looking backward and thinking about when we saw that dramatic pupil decline during the pandemic, and that you're actually seeing that the returns of pupils have offset some of the reductions, and that's reflected in these numbers. I mean, that's shocking in a way that we still have a decline even with the kids coming back. Do we have any sense of, how many kids are still disconnected? Are there any? Are we anticipating kind of a trend over time, or is this what we think we're going to get?
I mean, it's, I think, speaking pretty well for us, but in a normal drop, if you looked at, say, 2010 through 2020, on average, we would have been losing closer to 8,000 to 10,000 pupils per year. So that you see these declines of 6,000, 5,200. That takes into account slightly that the decline in birth rates has slowed a little bit since that time period, but most of that difference is just this sort of estimate of pupils filtering back into the system. We don't know exactly how many are still out, but there was a significant drop, and as I said, we're still below the trend. Whether we ever completely get back to the trend or not is unclear. But yeah, right now, the factors are just taking that into account, and you're seeing it through reduced year-over-year declines compared to the 2010 to 2020 period.
All right, thank you so much, and thank you for the work in putting the estimates together for us. Appreciate it.
I move adoption of the estimates as presented.
I second it.
All in favor?
Aye.
The estimates are adopted. Thank you. All right, with that, we will take a break to discuss the staff numbers that have been presented, and we will be back in a bit. Thank you. We stand at ease. No.
Motion to accept those?
David made our revenue disappear. My worry is when I try to zoom in with it the other way.
All right, so we will reconvene. David, will you walk us through the proposal in front of us, please?
So under the agreement, the forecast for FY23 general fund revenue would be about $14.8 billion. It would be down 2.8% from FY22 and about $800 million from the May forecast. School aid fund would be down 1.1% for about $17.6 billion and about $440 million above the May forecast. You can see in 2024, we would be forecasting 2.1% growth in the general fund, 1.2% growth in school aid fund. Combined, those would lead to an upward revision over May of about $1.26 billion in GF and school aid fund revenue. For FY25, we would forecast 9.3% growth, bringing the general fund to $15.5 billion. 4.7% growth in school aid fund, bringing the forecast to $18.3 billion. Total revenues would be $33.8 billion, 6.7% up from FY24. And you can see the revenue limits and the inability to make a determination for the trigger given the financial statements and the previously agreed upon school aid numbers.
So on your growth rates for 25, are those off of 23?
Yeah, it looks a little weird.
Okay,
We'll get those fixed.
okay.
The numbers should be correct.
The numbers are correct.
The numbers are correct, yes.
It's 2.6, 2.3, 3%, 2.3, and 2.6.
Okay. Is there any discussion? All right, do I have a motion to accept the proposed consensus?
Move to accept the estimates.
I second.
All in favor?
Aye.
The estimates are adopted. And I believe that concludes our business. Are there any concluding remarks?
I just also want to thank staff. I know that we've all thanked staff in various respects. As we kind of looked at the presentation earlier, we saw that there was quite a bit of work to do to get to these consensus numbers. And I know this was a lot of late nights leading up to this and a lot of late nights this week to kind of get us here today and to make our jobs as principals a bit easier. So just really appreciate all of the people who are here and all the people who are back in the office supporting this effort.
If I may, Madam Chair, in addition to thanking the staff for all of their hard work, congratulations on your own first time chairing the consensus conference.
Thank
You've
you.
done a very fine job.
Thank you. And I think we all will look forward to the next several months of data coming in that we can use and prepare for the next conference, and we'll have a lot better handle on some of these things that I know, we've talked about the differences among the forecasts, but we'll have a lot better handle at that point. So look forward to seeing everyone again in May. Thank you. And we are adjourned.